Good day and welcome to the D-Marq-AnalyticS channel. In this week's video, we will look into an interesting topic. Entropy modeling for tech stocks. Predict market decay before the next correction. Introduction: the physics behind your portfolio's collapse. Your tech portfolio isn't just overvalued, it's obeying the laws of physics. While the masses chase the hype of 2026, AI, semiconductors, autonomous agents, quantum-accelerated compute, thermodynamic entropy is quietly signaling a massive structural collapse in market momentum. Today, we're going to quantify that decay. We're going to map how concentrated capital transitions from ordered growth into chaotic dispersion and pinpoint the exact threshold where momentum dies. This isn't technical analysis, this isn't macro forecasting, this is physics applied to markets, and it gives you an asymmetric advantage. You'll know when to exit before the correction hits. Let's break the illusion of stability and expose the entropy curve forming beneath the 2026 tech rally. Section 1. The illusion of order in modern tech. 1.1. The false stability of 2026 AI and semiconductor valuations. On the surface, mega-cap tech looks invincible. AI hyperscalers, chip manufacturers, and agent infrastructure providers are posting record revenues. Valuations appear stable. Volatility is low, capital is concentrated. But that stability is an illusion, a low entropy state. 1.2. Low entropy, when a few stocks hold all the momentum. In physics, low entropy means high order. In markets, low entropy means capital concentration. When 70–80% of index performance comes from fewer than 10 companies, the system becomes predictable, ordered, fragile. This is the same fragility you see in closed thermodynamic systems. The more ordered they become, the more violently they break when equilibrium shifts. 1.3. The hidden risk of a closed market system. A market dominated by a handful of megacaps behaves like a sealed container. No new energy enters, pressure builds, the system becomes brittle. Growth looks predictable, until the moment it isn't. This is the setup for entropy expansion. Section 2. Thermodynamics of a market peak. 2.1. The second law of thermodynamics in finance. The second law states, entropy always increases in a closed system. Applied to markets, order always decays into chaos. Tech valuations cannot remain perfectly ordered. Liquidity cannot remain perfectly concentrated. Momentum cannot remain perfectly linear. 2.2. Identifying the dissipation of ordered buying pressure. The first signs of entropy expansion show up as micro-volatility spikes, declining volume on green days, increasing randomness in intraday price action. Weakening correlation between megacaps and the broader index. These are the heat leaks of the system. 2.3. Liquidity saturation, when market energy peaks. Liquidity is the market's energy source. At the peak, liquidity inflows plateau, marginal buyers disappear, market depth thins, options dealers reduce gamma exposure. This is the moment the system reaches maximum saturation, the point where entropy begins to rise. Section 3. Mapping the threshold of chaos. 3.1. Volatility clusters, the first break in the system. Entropy modeling focuses on volatility clustering, not price. When volatility clusters tighten and then suddenly widen, it signals a shift from linear to non-linear price action, a breakdown in trend persistence, a rise in randomness. This is the threshold of chaos. 3.2. Why traditional indicators fail. Stop losses, moving averages, RSI, all assume continuity. But entropy-driven reversals are discontinuous. They don't follow trend logic, they follow energy logic. When the system runs out of energy, price collapses regardless of technical support. 3.3. Visualizing the transition zone. The transition zone is where upward momentum becomes expensive, downward momentum becomes cheap, market makers widen spreads, options skew steepens. This is the moment where maintaining the uptrend requires more energy than the system has left. Entropy wins. Section 4. The dispersion signal and capital flight. 4.1. Capital leakage. The the first sign of structural decay. As entropy rises, capital begins leaking from mega-caps into mid-caps, speculative AI plays, commodities, defensive sectors. This dispersion is not diversification, it's escape velocity. 4.2. The options. Market reveals structural fragility. Weeks before a correction, the options market shows rising put-call ratios, increasing implied volatility on long-dated options, dealer gamma flipping negative, skew steepening aggressively. This is the structural fragility signature. 4.3. Why retail feels safe while institutions exit. Retail sees stable prices, strong narratives, low realized volatility. Institutions see entropy rising, liquidity thinning, correlations breaking, risk models flashing red. Retail confidence peaks at the exact moment institutional entropy peaks. Section 5. Executing the asymmetric exit. 5.1. Liquidating based on entropy thresholds. Your exit strategy is not based on price, it's based on volatility clustering, liquidity saturation, entropy acceleration, options market fragility. When entropy crosses the threshold, you exit, even if price is still rising. 5.2. Pivoting into defensive volatility instruments. As entropy expands, the system transitions into high disorder. This is where defensive instruments thrive. Volatility ETFs, tail risk hedges, long-dated puts, short-duration treasuries, systematic volatility capture strategies. You're not running from the chaos, you're monetizing it. 5.3. The repeatable checklist for the next cycle. To prepare for the next tech concentration cycle, monitor capital concentration ratios, liquidity inflow velocity, volatility clustering patterns, options market skew, correlation breakdowns, entropy acceleration curves. When these align, you're at the beginning of a new low entropy cycle, the next opportunity. Conclusion: predict the collapse before it happens. Entropy modeling doesn't predict price, it predicts decay, it tells you when. Order becomes chaos, momentum becomes fragility, growth becomes saturation, stability becomes illusion. The 2026 tech rally is not immune to physics, it is governed by it. By applying entropy modeling, you gain the ability to exit before the correction, reposition into volatility, and re-enter when the system resets. This is how you stay ahead of the next collapse, not by guessing, but by quantifying the inevitable. If you've found this week's topic helpful in any way, kindly hit the like button and share this video with anyone you think might find it interesting. Please feel free to subscribe if you'd like. We want to thank you all for staying till the end, and we wish you all a wonderful day ahead.